Welcome to the Thursday edition of the Tech Stocks Daily Podcast. Buckle up as we zoom through today's tech titans in the stock market. First up, UiPath navigates financial turbulence with a blend of solid earnings and cautious future guidance, balanced by sizzling AI innovation. Next, Meta gets tangled in spicy memoir drama and shakes up its fact-checking game with community notes, all while its stock takes a dip. The trade desk faces a high-stakes lawsuit, but stays a tantalizing prospect for long-play investors in ad tech. Finally, Symbotic teeters through stock swings, flaunting bold growth projections. Each of these tech juggernauts has an unfolding story packed with anticipation and opportunity. Let's dive in. Let's dive into the roller coaster that is UiPath, tracing the dips and loops of its latest financial ride. UiPath, the powerhouse in AI-driven business automation, made quite the splash on Wall Street, but not the kind they were hoping for. Their recent financial results shook up the stock market, leaving investors with furrowed brows as they processed both positive and not-so-rosy news. To put it straight, UiPath's fourth quarter earnings were a mixed bag. On the one hand, they reported earnings per share of 26 cents, which sprinted past the analyst expectation of 20 cents. A bravo moment. But wait, the company also served up a quarter slice of revenues just a tad shy of the consensus target. They posted a $424 million revenue figure, barely missing the $425 million mark anticipated by analysts. Close, but no cigar apparently, as the sound of dropped expectations echoed across investor meetings. But the real kicker came later. In their guidance for the first quarter's revenue, UiPath hit the brakes harder than Wall Street expected, with estimates between $330 million and $335 million. That's quite a distance away from the much pepped-up projection of $368 million that analysts were betting on. This tepid outlook turned up the volume on concerns about the company's future growth, and suffice to say, the market greeted this with a collective groan. The context? UiPath is racing through murky economic clouds, where U.S. trade policies and macroeconomic uncertainties hang like ominous storm clouds. CFO Ashim Gupta recently pointed out these geopolitical issues add unwelcome complexity to their fiscal path. So, even with some tariff tension released, there's enough unpredictability in the air to make Wall Street cautious. In spite of the grave scenery, folks still found silver linings. UiPath ended fiscal 2025 with an innovation bang, touting advanced AI technologies like Autopilot and Agent Builder, and beefing up its arsenal with the Peak AI acquisition. Their platform continues to be a strong contender with 3,000 AI agents being put to work, a stat that underscores their ongoing commitment to technological evolution. Some strategic partnerships, such as those with Deloitte, aim to strengthen UiPath's foothold in various fields, adding muscle to their long-term game plan. Not all the numbers painted a grim picture, though. Operating margins hit a record 32%, and UiPath's annual recurring revenue clocked in at $1.67 billion, albeit slightly down from previous expectations. As we navigate into fiscal 2026, UiPath expects revenue growth to downshift a bit from 9.3% to 6.8%, with projections resting between $1.525 billion and $1.530 billion. The takeaway here, the company is steered not just by spreadsheet success, but by innovation horsepower and strategic directions. Ultimately, while UiPath might have had a bit of a stumble on the revenue side, their energetic strides in AI and strategic alliances keep the beacon of optimism lit for investors willing to ride out the storm. Keep those seats buckled, because the journey's far from over. Hey tech enthusiasts, it's a roller coaster day for Meta Platforms in the news today, and boy, do we have some headlines to unpack. First, Meta Platforms stock took quite a tumble, sliding down by 4.67%. Now before you start hugging your cat for emotional support, remember that the entire market has been a bit of a shaky ride lately. The overall S&P 500 and NASDAQ composite dipped as well. The culprit? Those pesky trade war fears are in the spotlight again. Despite some favorable inflation data, the looming threat of escalating tariffs has everyone on edge. Meta is feeling the squeeze not only from the volatile market, but also thanks to juicy drama over its content moderation policies and a tell-all memoir. Yes, former Meta employee Sarah Wynne Williams published a memoir stirring up some chirpy chatter with inside depictions of Meta's culture and CEO Mark Zuckerberg. In a "have we learned nothing from airing dirty laundry" moment, Meta's attempting to block the book's spread like it's a questionable college rumor. The chewy morsel for investors, however, is whether this impacts Meta's brand perception, potentially affecting the company's well-being in the market. Flipping gears to product news, Meta is saying goodbye to its third-party fact-checking program and is instead rolling out its community notes. Think of it like a Wikipedia for Zuck's universe, where users can append fact nuggets to Facebook, Instagram, and Threads content. Meta is handing the fact baton to around 200,000 enrolled users, and juicily inviting more with an open waitlist. It's a bold taste bud tingle since these notes are ranked by diverse perspectives, supposedly minimizing bias. Let's see if this update can keep the info salad from wilting into news goo. Next up, investor lenses zoomed into how Meta stands against competitors like a yoga pose challenge. On paper, it's a mixed bag. Meta's prompting giggles with its price-to-book and price-to-sales ratios, indicating it might be overvalued relative to the rest of the industry. But this social media titan is sketching profitable smiles with high return on equity and eye-popping revenue growth, towering over its peers like a financial colossus. So, is Meta still the apple of the stock investor's eye, or a curious pear in the chaotic fruit bowl that is the tech market? Even amid its stock drop, Meta flashes its charismatic potential as a lucrative pick during any market fall. They've packed a wallop of an ecosystem worth biting into, sparking engagement fire with features like Reels and generating shiny revenues with AI twinkling in the shadows. It's a scenario of watching this titan wade through market ebbs and flows. Will they waddle or sprint through the trading jungle? Stay tuned, friends. With evolving challenges from memoir dramas to algorithm adventures, Meta surely doesn't disappoint in keeping their narrative precisely like their share prices, quite dynamic. The trade desk is making headlines today, and it's quite the roller coaster ride for both the company and its investors. Two big stories are drawing attention: a class action lawsuit and ongoing market debates about its stock potential for long-term investors. So let's dive in like we're cannonballing into the deep end of a tech pool filled with drama and excitement. First up, we have a lawsuit that's shaking things up like a solid plot twist in your favorite binge-worthy series. Levi and Korsinski, a renowned securities litigation firm, has filed a class action lawsuit against the trade desk. They're alleging that the company committed securities fraud, and here's why this is important. Between May 9th, 2024 and February 12th, 2025, the trade desk was allegedly less than forthcoming about some pivotal issues. The primary contention is around the rollout of their AI forecasting tool, Kokai. This tool was supposed to bring innovation, but instead delivered chaos in its transition from the older platform, Solomar. The complaint states that persistent issues with execution delayed Kokai's rollout, impacting the company's operations and revenue growth negatively. Really, if Trade Desk were a soap opera, this saga would be the cliffhanger before commercial break. Now, if that's left investors feeling jittery, the Trade Desk's stock performance might just turn those nerves into exhilaration for the long-term viewer. Despite a drop in stock value, knees weak, palms sweaty, mom's spaghetti, the fundamentals are the real heroes here. Over the years, the Trade Desk has built up serious investor trust by consistently beating its own financial forecasts. That is, until 2024 unceremoniously broke the streak. Imagine scoring a line of perfect tens until stumbling on live TV for an 8. Founder and CEO Jeff Green owned up to it, saying this shortfall was more of an internal hiccup than any big bad wolf of competition rearing its head. But don't discount the Trade Desk just yet. Several pointers suggest it remains a tempting prospect for long-term investors. It's not about short-term thrills. This stock brings the anticipatory joy of growing revenue, promising a space as massive as playing against giants like Alphabet and Meta Platforms in the $935 billion programmatic advertising market. The allure? Transforming consumer ad targets into wallet-happy conversions, especially in the fast-expanding connected TV sphere. The Trade Desk is sliding into the money ball of advertising, folks, aiming to land better results for ad spenders at more budget-friendly rates. And here's a cheeky tidbit for numbers nerds. While current prices may not board a cheap stock cruise, on a price-to-sales and price-to-free cash flow radar, the valuation has dipped about 50% from its historical rates. So for an investor with a keen eye for growth potential, the Trade Desk might just be tossing a golden opportunity into their court. In summary, hovered between courtroom battles and growth trajectories, the Trade Desk remains a captivating watch, balancing drama with potential like a tightrope walker clutching dreams of big returns. Because sometimes, even when the circus comes to town, a well-timed investment can yield the clowns and the show. Today, we're diving into why Symbotic Inc., a company nestled in the bustling world of technology services, is making headlines. This tech entity has become the focal point of financial conversations and investor musings, possibly igniting a flame of curiosity among keen market watchers. So, let's unfurl the details. First off, Symbotic's stock performance of late has been one heck of a roller coaster ride. Over the past month, they've posted a decline of 26.7%. To give you some perspective, this dip contrasts with the broader Zacks S&P 500 Composite's decline of 7.4%, and even beats the tech industry's loss of 19.1%. How's that for a dampened mood? When a stock trends, it's often due to some ripple in business prospects or a wave of media speculation, but it's critical to peel back these layers and inspect the core fundamentals. As investors strive to see beyond the headlines, there's a keen focus on Symbotic's earnings projections, and rightfully so. The company's projected earnings of 44 cents per share for the current quarter suggest a hefty drop of 81.8% year over year. Ouch. However, the overall picture isn't all gloomy, as they're forecasted to achieve a whopping 412.5% earnings increase in the current fiscal year. Things are projected to get even more exciting with an expected earnings growth of 91.6% for the next fiscal year. With figures like these, is this a phoenix moment for Symbotic? From a revenue standpoint, the jump seems promising too. With expectations of a 22.1% increase in the current quarter and sales estimates leapfrogging to 21.9% and 30.6% for the current and next fiscal years, there's a sense of hope that revenues might balloon in due time. The pen was lifted from the paper in the last quarter when Symbotic's revenues clocked in a 32.1% year-over-year increase, even if the revenue results etched a slight miss against consensus estimates. From a valuation perspective, though, Symbotic seems to be strutting around with an expensive price tag. Rewarded with a Zacks value style score of D, it's currently seen as overvalued against its peers. For the investors, this might mean proceed with caution. Now, viewer engagement time. Do you think Symbotic's growth projections make it a hot pick, or does its current valuation send a quiver down your spine? Are you betting on that upward trajectory or sitting this one out? Drop your enlightenment, concerns, or downright investment epiphanies in the comments below. Let's spark a conversation. All right, tech enthusiasts, let's put on our investment caps and dive into the world of stocks. Today, we're taking a closer look at, should you sell, buy, or hold? Buckle up. Buy, sell, or hold? Why buy? Despite a dip of 4.67% in the stock price, Meta remains a formidable player in the tech industry due to its robust ecosystem. Products like Reels and thriving revenue streams driven by AI development make it appealing. Yes, there's some drama with a tell-all memoir buzzing and controversies around content moderation. However, shifting to community notes for fact-checking via user engagement shows innovation, turning potential roadblocks into growth. Moreover, even though Meta's current valuation metrics like price to book and price to sales might make conservative investors twitch, their high return on equity and revenue growth could make seasoned risk takers see dollar signs. Why not to buy? The current market volatility, with backdrop headaches like trade war fears and global economic dicey spots, casts a shadow of caution. Plus, incremental changes can take time to bear fruit, especially with new endeavors like the crowdsourced community notes. Final take, hold. Based on today's news, I would hold on buying or selling Meta for a bit longer. Wait to see how the new initiatives play out and whether the memoir impacts brand sentiment long-term. Meta's fundamental strengths, consistent catch of AI and social engagement could be kitchen smoke hinting at some tasty meals down the line. Remember, always do your own fun homework when it comes to investing. This is one cog in your financial advice wheel. Trust your own research, stay tuned to further developments, and make sure those investment wheels spin smoothly. Happy investing, and may the stock market odds be ever in your favor. In today's whirlwind of tech market news, we've seen UiPath navigate a mixed financial performance with optimism in AI innovation, while Meta faces stock dips amid particularly juicy memoir drama and content moderation shifts. Meanwhile, the trade desk dodges excitement and drama with a looming lawsuit, while Symbotic maneuvers through stock declines but shows promising growth projections. In the broader scheme, each player tells a story of anticipation, challenges, and opportunities in the ever-evolving tech market. If today's batch of tech intrigue sparked your interest, why not like this video, subscribe for more insights, and share it with others who love a good tech tale. Don't forget to tune in tomorrow for another dose of the top tech highlights. Keep those notifications on because you won't want to miss what's next on our agenda.